really be the year of the small caps. Joining us now is Raymond James, Chief Investment Officer, Larry Adam. Larry, you ever see the great mid-90s movie with Vince Vaughn, Swingers, with John Favreau? Yes. At the end of the movie, they're in a diner, and, you know, it's late in the morning or whatever, and he stands up on the table. He goes, and you're all grown up, and you're all grown up, and you're all grown up. And I keep thinking that's kind of the Swingers equivalent of small cap stocks. Are they finally all grown up? Are they here to stay, or is this another head fake?
Look, we're neutral small caps, and I got to tell you, to your point, we've come into almost every single year the last 4 years looking for small caps to outperform, at least the consensus has, and it's all because of earnings. But through each of the last 4 years, you've seen their earnings estimates revised down more than 10% in each of those years. So we always say, until we see that optimism turn into reality, we're going to remain more neutral in that space.
So if that's the case, Larry, then do you have any kind of larger concerns about the rally this year? Do you think we kind of shake off a few days of headlines and then we're just going to continue to make new highs as long as we keep getting these positive reports from the semis and the banks?
Yeah, so we're a little bit more cautious this year. I mean, if you look at the consensus, they're looking for 7,600 on the S&P. We're at 7,250. And I think the fundamentals are really healthy, right? You're looking for above average earnings growth, margins, sales revenue, the Fed cutting interest rates likely this year. That's all positive. The two things that keep me more cautious are the fact that valuations are in the 95th percentile, which means that they're expensive and it leaves the market vulnerable to disappointments. Positioning is another thing I'm a little bit concerned of because you have a record amount of equities being owned by retail investors. And the question there is that if everybody already owns it, who's going to be there to continue to buy?
Right.
And then the other factor that we're looking at is that we are in a midterm election year. And historically, you do tend to see an uptick in volatility, particularly during the middle of the year into the election, and you get more muted or subdued performance in that year.
Let me put it this way. Would you be a buyer of the weakness in this, Visa, MasterCard, some of the banks on a poorly, policy, on a policy that would move against them, the healthcare plan that the president unveiled today? I mean, would that be a moment where you step in and you say this is all just midterm posturing and that you don't get a lot of chances to buy things at a discount in this market?
We would. I mean, I think a great example last week was with industrials when the president came out and said, they couldn't pay dividends and they couldn't do buybacks. Well, we're not in that sector or favor that sector because of those factors, right? And by the way, they have a very low dividend yield of 1.1% and they buy back less than 1% of their stock. We're in that sector because of its growth prospects. And if you look at its earnings this year, they're expected to go up 50%. That's why we're in that sector. When it comes to technology, same thing. If there's something that drives technology lower, I'd be a buyer in that particular sector as well. I'm a little bit more cautious with financials because I do think a lot of the good news was priced in, particularly at the end of last year. So we're a little bit more neutral in that particular sector.
So you're neutral on the financials. And what did you say about healthcare?
We are overweight healthcare as well. As you just mentioned, the headlines have been weighing on that. And until recently, you have started to see some of the more, for example, if you look at the the pricing deals that have been done with those 9 pharmaceutical companies, what's really important to me is that even after those deals have been signed, you haven't seen their earnings getting revised lower. They've actually started to get revised higher, which tells me that the worst case scenario had already been priced into that particular sector.